Well, good afternoon, everyone. We might get underway. My name is John McKinnon. I'm the Chair of Infrastructure Access Managers. I'd like to welcome you to our webinar this afternoon. Let me first acknowledge that the land on which we are variously meeting. I live on Dharawal country, and I'm sure there's lots of different Aboriginal lands on which we meet. We pay respects to all their elders, past and present. So a little bit about IAM to start with. Some of you know as well, you may be very new to IAM. We're a small boutique fund manager. We started 2 years ago when a few of us got together and realised there's a great opportunity out there. First of all, unlisted infrastructure is an asset class that is a great diversifying asset class, offers very stable returns long term, but most smaller investors don't have great access to it. It's something that tends to be the preserve of your large superannuation funds. So we thought here's an opportunity to provide access for smaller investors to a very attractive asset class. And secondly, we saw an opportunity to make a difference, to accelerate infrastructure towards a zero carbon future. On that front slide, there's a quote from Mark Carney, basically saying we're not going to get to net zero if all we do is buy green infrastructure or buy green assets, buy nice stuff. We have to transition the old stuff as well. And so this fund gives us an opportunity to do that, to buy small stake in some older, not so green infrastructure, but help push that transition to where it has to go. So we're going to talk a bit about that today, what that looks like in practice, what our fund has to offer. First of all, is to introduce us, the team that's on the webinar with you. As I said, my name is John McKinnon. I'm the chair of IAM. Some fellow founders here on the call with me, Richard Dennis, Jonty Lowe, Eitan Lenko. And then more recently, we've had Dan Madovan and Amanda Goodman join our team. Dan and Amanda have vast and recent experience in the funds management business, and we're very pleased they've come to help us. Of the original four of us, we have a variety of experiences. I was in funds management for quite a long time, but going back some years now. Richard is, of course, Chief Economist with the Australia Institute. Jonty's had vast experience of business and government relations. And Eitan is Chair of BZE. So very well connected with this transition we have to make to a low carbon economy. So with that, I'm going to hand over to Richard. He's going to talk a bit more about unlisted infrastructure and the great opportunities we have ahead of us. So over to you, Richard.
Thanks, John. So welcome everybody. Richard Dennis, some of you may know me as Chief Economist at the Australia Institute, but today wearing my Infrastructure Access Manager hat. And just a bit of further introduction by way of what John said. The assets that we'll be talking about today, I came into this unlisted infrastructure business a few years ago when the infrastructure fund that we invest in rang me up and asked me for some strategic advice about the Port of Newcastle and a conflict that Port of Newcastle was having with Glencore. So there's lots of moving pieces to this idea of investing in unlisted infrastructure, both from a returns point of view and an impact point of view. And I hope we can get to the bottom of some of those in questions at the end. But first, let me just quickly talk about what we see as the opportunity here. Obviously, in the US, you see Joe Biden talking about an enormous investment in new infrastructure in the US. A lot of it green, but a lot of it just upgrading what's already there. And that Biden plan is enormous in scale, but it's actually being emulated around the world. And here in Australia, while I question the benefits of our so-called gas-led recovery, there's no doubt that at the state level and the federal level, there's an enormous growth in infrastructure spending taking place, both because we have to build new green infrastructure and we have to update existing infrastructure. And with population growth and economic growth, we just need to build more infrastructure. So there's a lot of infrastructure assets out there that already exist, that are already in funds like ours, but there's also a lot of opportunities for new ones, and we're positioning ourselves to take advantage of both. As I said, climate change is obviously a key driver of a lot of the planning behind a lot of infrastructure. But of course, it's not just things like solar panels and windmills. It's things like the electricity distribution network in Australia, which we're invested in, the new interconnector between South Australia and New South Wales that will take a lot of renewable energy from South Australia into the eastern states. That's owned by Electranet, one of the assets that we'll talk a bit about today. So there's an enormous amount of new money going into infrastructure. There's an enormous transition task for the existing infrastructure. And as John said, to quote the former governor of the UK Reserve Bank, we can't get to net zero just by buying the green assets. We need to go where the emissions are, and we need the discipline to go there and assist in the transition of those. And we'll talk a bit about that today. Amanda, can you go on to the next slide for me? So the benefits of unlisted infrastructure. So by definition here, when we're talking about infrastructure assets, ports, airports, electricity distribution systems that are not listed on the stock exchange. So we're not talking about Sydney Airport, which is one of the few listed airports you can buy in Australia. We're talking about those big infrastructure assets that are held privately. And a lot of people perhaps don't realise that even though they're held privately, because of the unitized structure of the vehicles that do own them, you can buy into them. But as we'll see, it's historically been a bit hard. So these unlisted infrastructure assets have been sought after by particularly the industry superannuation funds in Australia for decades. Why? Because of the predictable, stable, long-term cash flows that come out of them, combined with much lower volatility, and unlike other things that yield stable cash flows and provide volatility, strong capital growth as well. So unlisted infrastructure assets, according to the Productivity Commission, were the best performing asset class in Australia in the 10 years to 2017. And according to the big industry funds, a lot of them credit their outperformance because of the shift that they've taken in recent years and recent decades away from cash and into unlisted infrastructure. So the benefits are there in terms of cash flow, low volatility, capital growth, but also a lack of correlation with movement in the equity markets. So they're the reasons that why the big industry funds in particular have put so much in. They're the benefits that we emphasise. But of course, as an unlisted asset class, it doesn't have the liquidity of a listed asset. Next, please, Amanda. So our structure, we as infrastructure access managers manage the Infrastructure Access Fund, which is really just a feeder fund which collects up investments from smaller investors and puts it into this thing called the Infrastructure Fund. So actually, we'll just go straight on to the next slide, Amanda. So because the Infrastructure Fund, which we'll talk about later, you can Google it, it's not hard to find, anyone can invest in the Infrastructure Fund, but the price of entry is around $15 million. So for people that can't write a check that big, previously they'd been unable to invest in a fund like the Infrastructure Fund. Because we've got a small unit trust, we can aggregate smaller investments, get above that threshold, which we did back in 2019, and we're investing on behalf of our investors in this large wholesale infrastructure fund, which in particular has assets focused on transport, airports, seaports, but a lot of utilities, and also some other things that you might not think about as infrastructure, but effectively privatised assets with very stable regulated returns, like the New South Wales Lands Titles Office. I'll talk briefly about those in a minute. But again, to recap what John said before, our approach, we're a small investor in a large fund. We're not for a minute suggesting that we can throw our financial weight around, But what we've already done and what we aim to do is to bring quite a new voice into these asset management conversations. A new voice, new ideas, and, you know, quite simply, I think we're a long way down the track in thinking about these issues compared to the larger institutional investors who own a lot of the units in these trusts. So we've already pushed for stronger ESG policies across the infrastructure fund. We've already engaged with the asset manager on a number of things, particularly the port, which I'll talk a bit about in a minute. But in short, we as a fund manager, while we want to do something simple, aggregate investments, put them into an interesting, what we think is attractive return space, we also want to take our voice and put our voice where other people's money is. That is, while individuals wouldn't get a chance to speak to asset managers or the asset manager or the management of individual assets, we do get that opportunity because of this structure. And in turn, we can push them on their ESG policies, their decarbonisation policies, etc. Amanda, next slide for the assets. Oh, no, we've got another one. So some of the examples of this. So as I said before, the investment, the ESG strategy for the infrastructure fund, we've already played a role in that. I used to be on the board of Queensland Airports Limited. At the beginning, I said my interest in this came from being invited by the management of the infrastructure fund to give them strategy advice. So before we even set this fund up, I was appointed to the board of Queensland Airports. Part of the conversation that I started there led to Queensland Airports Limited signing the largest green bond in Australia for refinancing the construction of a new airport terminal at the Gold Coast. In short, they get cheaper interest rates if they meet commitments for reduced energy use within the airport. A very simple thing, but again, the kind of conversation that previously hadn't perhaps been taking place in this space. The Port of Newcastle, again, that was the trigger for my involvement with the infrastructure fund in the first place. Their diversification plans are enormous, and I'm excited to say we'll be hearing from the chair of the Port of Newcastle in a minute. But suffice it to say, the world's largest coal port is determined to become a large container terminal in Newcastle, not just to transition its own business, but to transition the entire Hunter economy. Now, importantly, all of these ESG things that we're pushing, we believe will actually increase the returns of these assets. So to be clear, we're selling access to what we think is an attractive unlisted infrastructure class. That's the product. But as fund managers, we think that our advocacy for a faster an acceleration of decarbonisation won't come at a cost to investors in terms of lower returns. We actually think it will both boost returns and lower risk. Next one, please, Amanda. So the infrastructure fund, established in 1998, this is the actual fund that our feeder fund invests into. Currently managed by Mira, Macquarie Infrastructure and Real Assets, who replaced Hastings Funds Manager. Guardior is the trustee of the infrastructure fund. The target rate of return is 10%, and we'll come to returns, but the fund has been performing very well over decades. Core Plus means that they try to focus on not just assets with stable infrastructure returns, but growth opportunities on top of those returns. Currently, the portfolio is weighted towards transport assets. As I said before, they've recently sold down some smaller assets to focus the product on both the big existing ones and exciting new emerging opportunities. Next slide, please, Amanda. So very quickly, the assets, Queensland Airports. Basically, the infrastructure fund has exposure to all of the airports in Queensland except Brisbane Airport. So Gold Coast and Cairns are the biggest ones, but also all the smaller regional airports that are exposed to the regional economy and to the tourism sector. So whereas the big international airports have been really hit hard by COVID. Regional airports and tourism hubs haven't been, every airport's been hit by COVID, but haven't been hit nearly as hard. Perth Airport, North Queensland Airports is the owner of Cairns, Queensland Airports Limited is the owner of Gold Coast, Port of Newcastle I've talked about, Porterbrook is a rolling stock company in the UK privatisation, Electronet, big investors in the poles and wires that move electrons across the country, Ballarat Water, it's obviously a water distribution company in and around Ballarat, and Australian Registry is really the New South Wales Lands Titles Office. So quite a diverse portfolio, but particular with being infrastructure, particular exposure to transport. Next one, please, Amanda. Now I'd like to introduce Roy. So Roy Green, Professor Roy Green. Roy and I go way back. Roy taught me economics a long time ago. We lectured economics together. Roy was until recently the Dean of the Business School at the University of Technology. He's the former chair of the Queensland Competition Watchdog and was appointed as chair of the Port of Newcastle a few years back, maybe 3 years ago now, specifically to oversee what is, I think, one of the most exciting transitions in Australian infrastructure. Indeed, I think of any regional economy in Australia. So, Roy, if you could give us a blast on what transitioning a coal port looks like.
Sure, Richard. Thank you for that. Thank you for the intro, and good afternoon, everyone. As Richard indicated, I'm chair of the Port of Newcastle and have been since late 2017, early 2018. Now, the Port of Newcastle, as Richard pointed out, is the world's largest coal export port, thermal coal. And when it was privatised in 2014, the assumption was that the business model around coal would be a robust one, and no impediments to growth were foreseen at that time, either by the government or even possibly by the investors. But of course, now we know that the outlook for coal is less certain than what might have been imagined at that time. In fact, the only certainty is that the market's likely to shrink. And so the Port of Newcastle is now in a position where it must rethink its business model, and it must do so in the context of its region, because the Port of Newcastle is very much part of the Hunter region and its economy. Its trade is worth $25 billion to the national economy every year, 95% of which is thermal coal. And if it undertakes a transition, it will be a transition in the context of a major energy and industrial transition for the region as a whole. And that's the way the port has seen it, really, since its foundation 200 years ago. And coal has been its major trade in that entire period. So now we need to rethink. And we have an asset here which is worth $2.3 billion. It's currently experiencing a stable revenue every year around $100 million. We ship 170 million tonnes of cargo every year. Again, as I said, almost entirely coal through 4,600 ship movements. Now that sounds like a lot, but in fact, it's only 50% of the capacity of the port. It can do more. And so the strategy that we've developed as an organisation is to diversify, but to do so in tandem with the continuing export of our thermal coal trade. This will depend, of course, on external markets. We have no control over that, but we do control how we respond to those market movements. And the very clear strategy of the port, and again, in the context of the region as a whole, is to develop new trades. Now, I'll come back to the restrictions on that in a moment, but the first thing that the port has done has been to ensure that we have a very clear and far-reaching ESG strategy, which has been agreed and approved by the board. And that means that we're rebranding ourselves at this point from being a coal port to an energy port, because we want to look at new sources of energy, renewables in particular. We're electrifying the port, ensuring that as many of our assets are generated by renewables as possible. And we're investing and certainly exploring new trades in the energy space, particularly hydrogen. So a lot of work is going into the hydrogen strategy in conjunction with the local university, University of Newcastle, and various other entities with an interest. The Newcastle region has been designated as a hydrogen cluster by the federal government and a hydrogen hub by the state government. And that's led to the release of funding, in the case of the state government, $70 million to encourage the development of hydrogen, not just as a domestic source of energy, but also potentially as a hydrogen export. And obviously, the technology is in place for all of that, but the cost competitiveness of hydrogen is yet to be addressed over time. Certainly, the domestic use of hydrogen is something that will power local manufacturing, especially energy-intensive manufacturing. And in the longer term, we hope that whatever form hydrogen can be exported in, whether it's methanol or ammonia or some other substance, it can be cost competitive with other forms of energy. And indeed, as people on this call may be aware, there is already an agreement in place between the Australian and German governments to the effect that if Europe is the world's largest importer of hydrogen, then Australia, hopefully via Newcastle, will be the largest exporter. So that's one of the things we're doing, and there are other diversified trades that we're looking at as well and investing in. But the big one, of course, as Richard mentioned, is the container trade. 95% of the world's trade is now containerized. A lot of the bulk trades that would have otherwise gone through the Port of Newcastle are now containerized. That includes grain to a very large extent. About 20% of this huge grain harvest that we've been experiencing in the Hunter and the northern parts of New South Wales will be containerized, believe it or not, containerized on the Port of Newcastle and then going down the M1 or the Northern Line to be exported via Port Botany. Somewhat inefficient, you might think. And so the container proposition for the Port of Newcastle is key to our future. Metal products as well, which used to be exported through the Port of Newcastle in bulk, much of that is now containerized, from Tomago aluminium to Molly Cop steel products. So what's stopping us from investing? We want to invest $2 billion of our owners' money in a state-of-the-art, automated, large-scale deep water container terminal. This has been advocated for many years. In fact, advocated since the closure of the BHP steel blast furnace in 1999. The land was cleared on that site to make way for a container terminal, but 20 or more years have passed and it still hasn't been done. This is due to many factors, both commercial and political. Right now, the key factor is political, because when the ports were privatised in New South Wales, Port Botany in particular was privatised with a restriction on the Port of Newcastle on its ability to compete with Port Botany. And in other words, the price of Port Botany was boosted above its retention price with this anti-competitive restriction, which we've challenged in the courts and done much agitation about. We haven't had much luck, as you would have seen from the media thus far. Crown immunity covers the form of that privatisation, but we are keeping up the pressure and expect in the not too distant future that there will be a political solution to this, because it's so obviously compelling for both state and federal governments for a private investor to invest in future infrastructure that is unavailable on the rest of the east coast of Australia. A deep water port in particular is necessary to accommodate the very large container ships that are now being built, 15,000 TEUs and above. No other port in Australia can accommodate those vessels because they require a deep water harbour, and that's exactly what Newcastle can offer.
Roy, I'll have to wrap you up in a minute, but can I just clarify that what you're saying is that I'm hearing a bit of it. That the private owners of the Port of Newcastle want to spend $2 billion to build an enormous container terminal, which at the moment there are regular constraints on, but politically, if those constraints are lifted, the port is sitting and ready to spend billions of dollars to help transition the entire hunt.
That's right. Done all the work on this. The business strategy and the business model is in place. We just need the starting gun fired by state and or federal governments. And we proceed with an investment that creates over time 15,000 FTE equivalent jobs and $2.5 billion of added value to GDP. So that's the plan.
And takes 1 million truck trips off the road to Sydney.
Pardon? Sorry, what's...
And takes 1 million truck trips off.
Well, exactly. It achieves three things. It diversifies Newcastle and its region. It increases greater port and freight efficiency. Australia lags way behind the rest of the world in terms of port activity. And it decongests Sydney because the bottlenecks around Port Botany are now becoming legendary.
All right. Well, we might wrap it. But Roy's going to stick and answer questions if people have got them. So start thinking about questions, everybody. And yes, Amanda, if you can just go to the performance slide. Okay, so last one from me, just in terms, again, I said at the outset that really what we're trying to sell here is access to a form of investment that the big super funds think has really helped to boost their returns and lower their risk over time. From inception through to February 2020, when COVID hit, we had a 9.9% return for the first 9 months, so annualized over 12%. So we were well over our 10% target. Of course, COVID knocked down the value of, nearly all assets in Australia. We've seen that. Since then, the unit prices have held up. The cash distributions continued to be paid throughout the crisis. And what we're now starting to see is the valuation of the assets starting to grow again as the assets are valued twice a year by external valuers based on actual and expected cash flows. And those asset values are just starting to recover now, which we actually think is an opportunity. While the equity markets have bounced back quite quickly, the long lags with valuation in unlisted infrastructure mean we still see an opportunity here to buy assets before the asset values are fully recovered. So obviously we can't make specific predictions about future asset values, but we can see that things are starting to pick up. And as vaccinations continue to increase, New South Wales obviously in for a tough time for a while, but Queensland regional airports and airports generally with a vaccinated population and the return to international travel should see higher than average growth. So I might now just hand over to Amanda and then we'll open it up to questions.
Thank you, Richard. And hello, everyone. I'm going to run everyone through some of the key terms of the fund that we wanted to point out, as well as walk you through next steps on how to invest. So with the Infrastructure Access Fund, we're targeting a total return of about 10% per annum, net of fees and costs. And we're also targeting annual distributions of between 3 and 4%, again, after fees and costs, which we expect are going to be paid half yearly going forward. Now, the fund is an Australian domiciled fund. It's denominated in Aussie dollars. And we at Infrastructure Access Managers are the managers of the fund, but we do have an external trustee called One Funds Management Limited. One and its affiliates also provide the trust with fund administration, custody, and registry services. Now, in terms of fees, the fees at the Infrastructure Access Fund level include an upfront establishment fee of 0.5% on your invested amount and an annual management fee of 55 basis points on the gross asset value of the fund. In addition, the fund does recover trustee and fund administration costs, as well as other fund costs, and all those fees and costs are outlined in the information memorandum. The minimum investment for new investors is $50,000, but for existing investors, you can top up your holdings with a minimum additional investment of $10,000. In terms of the term of the fund's been around 2 years now. So while there was a 10-year term on the fund, the remaining term is about 8 years, although we do have the ability to extend that term for two-year periods beyond that. And as with most unlisted investments of this nature, an investment in this fund should be considered illiquid. We do have a process in place whereby at the end of each financial year, investors who have held their units for over a year can request to have those units redeemed, but there's no guarantee we'll be able to accommodate that. And accordingly, your investment in the fund should be considered illiquid. So moving on now to how to invest. We are currently at the moment able to accept applications under an existing IM that was published about 2 years ago, but we are publishing a new IM right now. We were hoping to have it available for everyone today, but it looks like it's probably going to push out to later this week. And we will make sure everyone who's expressed interest in the fund or who's signed up for this webinar will get a copy of that revised information memorandum as soon as it's available. But in the meantime, if you would like a copy of the original information memorandum, please do let me know and we can get you a copy of that straight away. Now, in terms of timing, we are operating on a fairly tight time frame. We're trying to raise capital over the coming weeks so we can apply for more units in the infrastructure fund by the end of September. Now, this timing is driven because right now there is a limited opportunity to buy existing units in the fund, and those existing units are under Macquarie's current fee structure. We don't expect this opportunity to be available beyond the end of September. And once those existing units in the fund are sold, Macquarie has plans to issue new units, which will attract double the fees. So if you think this is an investment you might be interested in, it makes sense to come in now to ensure that the units we buy have the benefit of those lower fees. And to meet this timeline, we're asking for applications and funding to be in by the 22nd of September. So we in turn can meet the 30 September deadline of Macquarie. In terms of fund size, we're targeting a fund size of $50 million. And with all of IAM's products, this fund is open to wholesale investors only. Again, the minimum $10,000 top up for existing unit holders and $50,000 for new investors. We will make sure you get a copy of that IM when it's available, and one of our team will be in touch with you over the coming days just to touch base and see if we can answer any questions you might have. In the meantime, please don't hesitate to contact any of us. My contact information and Dan's contact information is at the bottom of the screen, so please take note of that, and feel free to reach out to us at any time. We'd love the opportunity to chat to you further about the fund. Now, I think that's it in terms of the formal presentation. I might hand over to John T to see if we have any additional questions. And I apologize, I should have mentioned earlier, if you do have questions, please make sure to pop them in the Q&A channel. You can just click the Q&A button on your screen and pop them in there. And if we don't have a chance to answer everyone's questions now, although I think we've got enough time, we're happy to answer them offline as well. Jonty, over to you.
Okay, thanks, Amanda. We've got a few questions. So the first one I'll start with, I'll throw to Richard. How are you different to the Magellan Infrastructure Fund?
Well, I think you're on mute, Richard.
Someone had to do it, didn't they? Sorry. Look, to some extent, I have to take that question slightly on notice, Jonty. I wouldn't claim expertise in the composition of the Magellan Infrastructure Fund. There are a small number of ways that people can invest into unlisted infrastructure in Australia. But what we offer is a very simple, very low fee way of doing that. Our structure is a straight feeder fund, which basically says, if you put money into our fund, we'll put 100% of it into this fund. And that's unusual. There are a number of funds out there that have effectively created a fund of fund structure. And sometimes those other products that describe themselves as unlisted infrastructure are actually a blend of unlisted infrastructure and listed infrastructure. Now, while that gives them a bit more liquidity, it also gives them more volatility and typically lower returns. So I'll look into and get back to the specific person about Magellan, but to be clear, there are a few ways that people can invest in unlisted infrastructure in principle, but our fund is quite unique in saying, look, we're a straight feeder fund. We're just putting your money straight into this, and we're only charging a small fee to do it, as opposed to, as I said, a more complicated fund-to-fund higher fee structure.
Thanks, Richard. We've got another question here, whether the fund is an impact investment. So I might throw to John for this one. Who I hope is
Thank you,
not on
Jonty.
mute.
Yeah, just doing the unmute. Look, I'll answer this by just with reference to that last question as well. One of the differences that between us and I think any other infrastructure fund on offer in Australia is that we offer this layer of impact over the top, where of the principles you see on your screen now, we are experts in various types of activism and impact investing. So we don't intend to be passive holders of our TIF units. We intend to do what Richard talked about before. We're actually trying to actively work with the other shareholders, the unit holders of TIF, work with the manager Macquarie, and work with any other stakeholders to see impact, to see those assets do their transition. So that is a major difference between what we're offering and any other infrastructure on offer in Australia. We actually are adding value as well as giving you access. We're adding value through that impact side. So the question, is it an impact fund? Traditionally, I say traditionally, it's a funny word because impact funds are pretty new. Often they will buy things that are nice. Right? Impact investments tend to be buying assets that are doing nice things, good things, renewable energy, disability housing, you know. We have taken a different approach and said, as Mark Carney points out in that quote at the start of our presentation, we need to buy the stuff that isn't nice and help it change. And for me, that's where the biggest impact is. The best way you can use your money is to take something that's polluting, that's important, that we need, but that needs to transition and help it transition. And so I think our fund is very much an impact fund, and that's how we're going to produce impact. And between us, the people you see on the screen, I think we have the skills and experience to produce some pretty significant impact.
Can I just add to that, Jonty? I mean, take airports, for example. At the moment, airports make a very large percentage of their revenue from the hire car industry. As the hire car industry moves to electrification, airports that have never sold any petrol to the hire car industry are going to actually make money selling electrons to the rental car businesses. These assets, these enormous non-green assets, are going to transition in the coming years and decades. We believe the quicker they do that, the better their returns will be, the lower Australia's emissions will be. But on top of that, we also think that almost by definition, infrastructure assets are some of the most visible assets in our society, in our economy. And having the Port of Newcastle say, we need to transition and here's what we're doing. Having airports say, we're not just installing huge amounts of solar to generate our own electricity, but we're actually preparing to sell electricity to the hire car industry as a revenue stream. Having these high profile assets front running this transition has got to make it easier for state governments, local governments, and eventually federal governments to admit the obvious.
And Richard, sorry to interrupt you, but there's a question that sort of feeds directly into this, which is, can you also talk more about how you will create change given the relative size of the fund, and how receptive are the main fund managers to the ESG agenda?
Yeah, look, good question. Look, we're not suggesting that as a small unit holder we can pull the numbers at any particular meeting and have our way. But because our co-investors are big institutional funds that are loudly committed to good ESG policies, we believe it's going to be hard for our big co-investors to disagree with a lot of our ideas about better asset management. That is, why would a large retail fund not support the kind of things that we're talking about? That would actually be high risk for our co-investors to oppose those sort of things. So on the one hand, we're not suggesting that our small ownership gives us any control, but it does give us access. And as John said, all of us involved in IAM have experience in taking small amounts of access and turning it into change. But then, of course, let's maybe ask Roy this question. But, so myself and Jonty and others, before even IAM was set up, played an active role in trying to get the infrastructure fund and indeed the Port of Newcastle to take transition seriously. Now, if we had influence over that before we were even investors, then I think our capacity as investors adds to that. But Roy, what do you think? Is it useful to have noisy unit holders telling you should be doing it faster?
I think there's no doubt about your role with the Port of Newcastle in being at least one of, but possibly even the primary author of its strategic repositioning prior to me joining as chair. And indeed, as one of the reasons why I was able to join as chair, because the owners at that time, and haven't said much about them, but it's a 50% each for TIFF and for China Merchants Ports with me as the independent chair. They had come to the realization, thanks to your advisory role, that the business model that was being run had a limited life, and that the port really needed to reconsider what it was planning to do over the next 10 to 15 years if it was not to become potentially a stranded asset. And so your personal role in that, and I'm sure that's going to be the role of this fund, was to help an organisation which would otherwise be regarded as a coal-related asset and therefore not something that anyone might want to invest in, to ensure that it moved into a transition path, which makes it a very viable and a very important investment opportunity, because in investing in such an asset, you're investing not in what it's done in the past, but what it's going to do in the future.
Thanks, Roy.
Thanks, Roy. We've got a question here on the port. So how is Newcastle Port likely
You're
by the courts earlier?
Jonty, could you repeat the question?
You broke up.
You broke up, Jonty.
Can I ask you to mute Roy while I ask the question? How is Newcastle Port likely to overturn the Botany Port restrictive trade terms when it wasn't possible via the courts earlier this year?
Yes, well, that's a very fair question. And obviously the ACCC has appealed. We weren't party to the original case. It was the ACCC that brought the case on competition grounds. Crown immunity has protected New South Wales Port's derivative Crown immunity at this stage, and ACCC is appealing that. But that could go on for a while. Meanwhile, the Prime Minister has made 4 visits to Newcastle in 3 months, and we've had a number of discussions with him, but most importantly, he has publicly announced that he intends to, and I quote here, remove the impediments to the Port of Newcastle's investment in a future container terminal. So the only question is when that might happen, and we expect it might be sooner rather than later, because obviously there is a jobs implication and an implication for how energy transition in Australia is run, and any government that can use the Hunter or enable the Hunter to become a prototype for such a transition for the rest of Australia will certainly reap some political benefit.
Perfect. Thanks, Roy. I've got a question that I think might be an Amanda question. I've got to find it again now. In the meantime, how frequently does the fund report to investors? That can throw to anyone.
Look, in terms of the Infrastructure Access Fund, look, we try to report quite regularly, both on obviously fund performance, but also on our impact performance. You've got me on the hop. I'm not sure when we sent our last update out, but certainly every couple of months we keep people posted on both what's happening at the asset level and the kind of things that we're pushing for.
Thanks, Richard. And are returns from the fund sensitive to interest rates? Maybe Amanda?
Or Richard, I might.
Yeah, sure. Yes, indeed. Look, low interest rates are very good for infrastructure assets. So, you know, in some ways they're a good hedge against and substitute for traditional kind of cash, low volatility, unfortunately low yield. So at the moment you've got very low interest rates. Infrastructure assets, because they have such stable and because they have such predictable cash flows, are typically highly leveraged at the asset level. So low interest rates both lower the costs of debt for the asset, but also in valuing the net present value of the future cash flows, you get lower discount rates, and in turn you see increases in the valuations of these assets. So we're still seeing this play out over time, but in short, low interest rates are typically good for both the free cash flow from infrastructure assets and the valuations of those assets.
And
if I can just add something to that, Jonty, the flip side of that is there's some vulnerability to interest rates increasing, but of course interest rates would increase in response to inflation, which of course also drives up your cash flows and asset values. So it's a good hedge in that sense as well.
Great, thank you. And if we could please clarify MIRA's involvement in IAF.
Sure, I'll take that one. So MIRA, Macquarie Infrastructure and Real Assets, are retained by the infrastructure fund as the asset manager who acts on behalf of the Infrastructure Access Fund. So MIRA do not own the assets. The assets are owned by the infrastructure fund, the trustee of which is Guardior, but MIRA are paid by the Infrastructure Access Fund to provide a range of asset management services, including, for example, appointing people to represent the fund on the board, to provide assistance to those assets in their refinancing, to provide assistance to people like Roy in his engagement with the state government and the federal government. So often, you know, go back a step, unlisted infrastructure is very poorly understood in Australia. The media often completely misunderstand it. You'll often hear things like, you'll often see journalists who report on this say that Macquarie own the assets in the fund when that's demonstrably not true. So there is often a lot of confusion around these things, but anyone that owns an investment property is likely to have a real estate agent that manages their investment property for them. The infrastructure fund retains the services of MIRA to manage their assets for them.
I'll just add on that, I think also going to the question is our relationship with MIRA, and fair to say in 2019 when we set up the fund, we were almost clandestine about it because we were worried about, you know, what MIRA would think about an investor in TIF that was taking a more active approach. But actually, fair to say that we've been, you know, almost surprised by the reception that we've had from Macquarie. They've invited us to input into ESG policies. We've been pretty actively involved with them on a number of issues. We recently arranged a briefing for them on the potential for Newcastle, the Hunter region to become a renewable energy industrial precinct and get them involved in that campaign. So, you know, we found Macquarie to be pretty actually receptive to our agenda and open to our ideas. So, you know, which, you know, as has been said a few times, other investors in the fund aren't taking that active approach. So that gives us an outsized role as a voice of the investors in the TIF fund.
Thanks, Aiton. The fees quoted for IAF, are MIRA's fees additional?
Yes, they are. So all of the the returns that we're reporting are net of all fees, net of Macquarie's fees and net of our own fees. Macquarie's fees, I can't disclose what they are on this call. They are, you know, we know what they are. We know that for new investments after September, we know they're going to increase, but I'm not sure we're at where with the ability to get people to sign NDAs, but cut a long story short, we are restricted in what we can say about Macquarie's fee structure. John, to you or Amanda, do you want to add to that?
Yeah, what I will add is we are able to share more confidential information after this call if investors sign a confidentiality deed poll that's been requested by Macquarie. So for questions of that nature, we should be able to assist, but on the other side of an NDA.
Thanks, Amanda. Roy, I've got another one for you on the port. For the Port of Newcastle diversifying, would it mainly be manufactured commercial products or would it be heavy industrial manufactured products and refined raw materials? If the former, wouldn't that create a greater distance from the biggest market, Sydney, compared with Botany? Or would it be more the latter?
Well, probably around a third of trade in manufactured goods is at this end or the Newcastle end of New South Wales. We estimate there's probably 500,000 TUs already knocking around the Hunter that go down to Port Botany very inefficiently at this point, mainly agricultural, but some manufactured goods that could immediately switch to the Port of Newcastle. And by the way, our consultants, Houston Kemp and others, have pointed out that this would result in a 30 to 50% reduction in costs for those engaged in trade. And I would think initially manufactured goods would be the smaller proportion. The larger proportion is agricultural products, grain, and also there's a lot of heavy machinery that goes back and forth as well between New South Wales and the rest of the world, especially mining equipment. So we would estimate that initially we're simply taking care of northern New South Wales trade, but ultimately as Port Botany becomes more and more congested, it's likely that a significant Western Sydney manufacturing trade would move to Newcastle. And the links between Newcastle and Western Sydney will over time become far more efficient and cost effective than between Western Sydney and Port Botany via congested rail and a WestConnex tunnel project that does not allow, by the way, dangerous goods, which is about 30% of trade going through Port Botany. So mean further congestion on arterial and suburban roads. The Sydney community is unlikely to put up with that forever.
Thanks, Roy. And look, bit of history, but as Roy knows, I was actually involved in the macroeconomic modelling exercise that helped kind of build the business case for what happens with transport in and around the port. And to give people, whether you live in Sydney or not, but picture the following. At the moment, when an enormous boat carrying 10,000 containers comes into Port Botany, 80% of those 10,000 containers get on a truck and leave the port. So 8,000 truck trips are required to take those containers through Australia's most congested city out to Western Sydney, where they're unpacked and put on another truck and shipped around the city and the state. So, for example, if you wanted to deliver a bunch of fridges to the northern outskirts of Sydney, you have to land it at Botany, take it through a congested city, unpack it in the western suburbs, put it on a truck, drive it to the north, whereas that same container coming into Newcastle can get into an uncongested port, onto rail, straight down through the Central Coast to the northern outskirts of Sydney. So for the import of containers, you can lower costs all the way from northern Sydney up to the Queensland border. And as Roy said, for exports, there is a lot of cheap land around the Hunter to facilitate not just light manufacturing, but warehousing. Whereas in Sydney, you've got a port that's already congested, surrounded by the most expensive land in Australia. So the opportunities both to divert existing inflows into Sydney, but also to transfer low value, low profit manufacturing out of expensive real estate into cheap real estate is an enormous opportunity, not just for the Port of Newcastle, but for the entire Hunter Valley.
I might just add, by the way, Richard, there's a number of examples of this around the world. The closest at hand is Port of Tauranga in New Zealand. Auckland faced the same problem as we did a few years ago and built a dedicated freight port, Port Tauranga, about 150 kilometres away, with a dedicated rail freight line, adjacent intermodals, etc. And while it hasn't eliminated trade from Auckland still continues. The trade at Port Tauranga has grown much faster and has enabled Port Tauranga to accommodate the very large ships. It's the only port in the Australia-New Zealand region that can take the ultra-large container vessels and enabling productivity at 49% higher than the Australian port average. And that's the sort of productivity we would see at a fully automated port, large-scale port at Newcastle, which is why, of course, our competitors are determined and hopefully in ultimately a futile gesture to stop it from happening.
All right. Well, thank you very much, Roy. We're about to wrap up, I think. But yeah, I mean, what a great point to end on. I mean, there's a very simple reason that Botany would prefer Newcastle not to be built. And that is because they know how effective it would be and how efficient it would be. And in terms of big picture, what we're talking about today, what an exciting potential transformation, not just of an asset, but of a region that comes from people being willing to, in Mark Carney's words, to go where the emissions are and invest in the transition, not just in the green stuff. Now, I might wrap up by going back to our chair, John McKinnon. John, anything you'd like to say, or Amanda, anything you'd like to say on the way out?
Well, thank you, Richard. And let me just first of all say one thing I forgot to say on the way in, and that is the disclaimer. This is not a financial advice. Please seek your own financial advice. This was for your information only, just to keep our trustee happy. Thank you everyone for joining us. I think what has been presented is a great opportunity not only to get into an asset class that would be a good investment, but to be part of forming the future of our country, transforming those assets. This is a real impact investment, and the more of you that join in, the more impact we can have and we really welcome you to join us on this journey. So Amanda has offered investment memorandums to everyone. I know we haven't got to all of your questions, but we have taken note of them, and we'll get back to you individually with answers to those questions. We'll make the video of this webinar available, and please contact any of us about further questions or about investing and joining us on this exciting future. So thank you once again, everyone.
Thank you.
Thanks, everyone.